you've probably heard of ethical investing. Ethical investing is a way for you to get invested in the stock market that better aligns with your values. There are a couple different names and terms that are used when we talk about ethical investing, such as ESG and SRI. ESG stands for environmental, social, and governance, while SRI stands for socially responsible investing. So these terms are often used interchangeably, but there are some slight differences, and they're kind of important. With SRI investing, a fund tends to focus on good industries, ethical industries, and avoid the bad industries. ESG investing doesn't really do that. Instead, what it does is it applies a screen to all the companies in the universe and chooses the ones that have better environmental and social and governance practices than others. So that is really the main difference between ESG and SRI. There are really three important things that everyone needs to know when they think about ethical ESG or SRI investing, whatever term it is that you want to use. The first one is that you might not always be getting what you think you're getting with an ethical fund. So as I just talked about, with ESG investing, it doesn't necessarily exclude certain industries or certain types of companies. It simply tries to find companies that score more highly or score better on environmental, social, and governance issues. So you might be surprised to see that your ESG fund invests in companies like Amazon or Halliburton, which is one of the world's largest fracking companies, or Agnico Eagle, which is a mining company. And you might not think these companies belong in an ESG fund. But the reason they're there is because they might score more highly on, say, environmental factors because they've done something to clean up their operations, or they have good social policies in terms of how they treat their employees. So it's very important to dig deeper. If you are serious about ethical investing, you need to read more about the fund, the approach that they take, and see what kinds of companies that they own. The second thing you need to understand about ethical investing is that you're probably not going to be as well diversified with an SRI or ethical fund as you would be with a more general fund. And this is because an SRI fund might exclude certain industries. So for example, it might exclude the energy industry, which means you're not getting exposure to that industry and you're more concentrated in the other industries. Now, with SRI funds, this can be a particular problem because some SRI funds are very focused on, say, green energy or solar energy or just renewable energy in general. And so you're going to have a really big concentration risk where you're excluding companies in other sectors like financials and consumer and healthcare to simply own companies involved in green energy production. So when you're looking at investing in a fund, it's very important to make sure you understand your diversification and concentration risk. That's not to say that you can't own those funds, but make sure it doesn't make up too big a part of your portfolio and that you're getting diversification elsewhere. Or you need to simply be comfortable with the fact that your portfolio could be more volatile than the overall market. And then the third really important thing to understand about ethical investing is that it's going to cost you more. So if you buy a regular ETF that tracks the S&P 500, for example, that is a very easy fund for someone to manage because all they're doing is mirroring what's in the S&P 500 index. So it really doesn't require a lot of work. As soon as you start excluding certain companies or having to do screens or apply different metrics, well, now you have to hire people to do that. You have to hire analysts and portfolio managers to do that work and to make decisions about it. And of course, that's going to cost you because these analysts and portfolio managers, they need to get paid. So while investing in the overall US market could cost you as little as 0.03% per year, an ethical fund might run you more like 0.4 to up to 1% per year for an ethical exchange traded fund. And again, you might be totally fine to pay that higher fee. It's just important to understand what it is you're paying and to look carefully at the details. The ethical investing world has been growing exponentially over the past few years, and for good reason. It's great to be able to invest in a way that makes you feel better about where your money is going. But you need to understand what it is that you're buying when you buy an ethical fund. So make sure that you read all the details of the fund, how it's managed, and what it owns before you invest.